Today we will talk about balanced advantage funds. Friends, balanced advantage funds have been getting popularity among investors. In fact, according to Amphi data, the assets under management of balanced advantage funds has increased by 50% in the last 1 year. So it has now reached to 1.80 lakh crore as on June 2022 according to Amphi. So friends, balanced advantage funds invest in a mix of both equity and debt based on a predefined formula. The idea is to deal with market volatility and offer better than inflation returns to investors. To talk more about balanced advantage funds, we have with us Mayukh Datta, Head Product Strategy and Communication at Mirae Asset Investment Managers Private Limited. Mayukh has overall experience of 23 years, in which he has spent over 17 years in the mutual fund industry. Mayukh has been associated with Mirae Asset for over 12 years now. So without wasting time, let me welcome Mayukh. Welcome, Mayukh.
Thank you, Nishan. Thank you for having us here. Appreciate it.
So Mayukh, my first question to you is that how would you define balanced advantage funds in simple language?
Okay. So in balanced advantage funds in simple language would be where the fund manager decides the allocation between equity, debt, arbitrage, and could be other asset classes if allowed under the scheme's investment universe. The fund manager takes the call based on certain predetermined rules. Let's call it model, or whichever way the fund manager would like to manage, where they would move from one asset class to the other on the basis of the assumption of overvaluation or undervaluation in a certain asset class and move where they would find more value to be there. So the operating factor would be the fund manager sees, the fund manager sees what is the market levels of a certain asset class, whether it is high, low, or what are their views on that, and try to bring in a dynamic way of managing switching between asset classes so that the investor is able to get lesser volatility and have a downside protection with participation on the upper side in equities. So that's how basically dynamic asset allocation, and the other word for that being balanced advantage funds, are being managed right now.
Okay. So Mayukh, different fund houses follow different models to arrive at asset allocations, particularly in dynamic or BAF. So how can a lay investor evaluate these models and make more informed decisions?
Sure. So I agree with you, Nishant. It is slightly difficult because everybody would have the same objective, which is to have to limit the volatility experience, give them a decent upside when it comes to equities moving up, or vice versa also. But to be able to judge that, it's very difficult because the way each fund house or each fund manager is managing this objective would be different. Some use different metrics, some use what are called in market parlance as pro-cyclical, counter-cyclical methods. Let's not confuse and get into those terms, but these are ways of measuring how the market valuations are. Let's put it simply on that. So everybody would be using a different metric. So in that sense, it becomes slightly difficult for the investor to judge A strategy to compare it to B strategy. So another way of doing that, possibly for investors, is to look at how the fund's user experience has been after these strategies have been put in place. So to explain it further, an investor can look at if the fund wanted to achieve a certain objective, which is limit the downside risk or the fall in the markets playing out in the investor's investment. When the markets went down, how did this fund behave? Which means what was the outcome at that point of time? Similarly, when markets went up, what was your participation in that? How much of the market upside was the fund able to capture and translate it into investor experience? So rather than just looking at point-to-point returns of the fund and then comparing, it is also one more filter is advisable or can be looked into, that you look at how the fund has behaved during the extremes. Because as a balanced advantage fund or a dynamic asset allocation, what you're trying to do is to reduce the impact of the extremes of the markets in your investment experience. So it needs a little bit more of a research to be able to come to a conclusion to compare one fund to another fund.
Okay. So personally, which model would you pick for your BAF investment?
Okay, so that's would be likes to, if I were to become a fund manager, and what would be the model. But I would like to say that it would be a good metric, which is something which is sustainable across market cycles. That's the first thing which I would look at. That I would not like to get into any strategy where I need to overlook after a period of time, which could be a year, 5 years, or whatever. So any strategy today should be good enough for the volatile markets, for markets going up and down, and over a period of time. Because then any strategy or any way of investment or managing a fund would only be worthwhile if it is able to live through many market cycles. That's why, because that's what this category is trying to capture, to have a median experience vis-a-vis the extremes of market volatility. That's the first thing I would do. Within that, if I were to take it one step more, I would probably look at schemes which would have a better and more sustainable metrics, not be too complicated, because then you will not be able to understand which time which metric came in and therefore was the experience. Rather have a simple model which would possibly put a lot of focus on market valuations, because that's what we are trying to capture at any point of time. Meaning, if markets were high, the fund would like to reduce its equity allocation, therefore let's call it profit booking or bring it back to debt. Or if markets were down and people are very wary or afraid or fearful of entering the markets, then the scheme should be able to enter equities with as much as it can. So that would be something which I would look at. In very typical terms, this would be something like a counter-cyclical approach, that when buy low and sell high is what I would like to achieve.
Okay. So Mayukh, do you think that fund managers should, revisit their model for dynamic asset allocation?
I would not think so that fund managers need to revisit. All fund managers have enough flexibility that as time goes, and if there are other complexities or other variables entering into the market, and they think those variables are important for their way of managing a dynamic asset allocation fund, they should have some leeway to be able to incorporate new variables into their model so that their investor gets a better experience. Some would try to achieve it with lesser variables, some with more. But with time, if any variable needs to be taken into consideration, I think fund managers should have a leeway to be able to do that within their current model, or if it requires any change, they should be able to do that, as long as investor gets the experience for which they are entering this scheme.
So Mayukh, as we already mentioned in the introduction part, that balance advantage fund has been growing. It has grown by 50% and now reached to 1.80 lakh crore. So,
Yes.
So what are the three key reasons for this rising popularity of balance advantage funds, according to you?
I think, Nishant, that's a good question. So we are also trying to pinpoint on that. But if I were to put those 3 points, first of all, is that first I would say it is that there is a attraction for this category, and rightly so. The first benefit which I see is that many times we do not know the call to action, when to take an action. So a balance advantage fund first takes away that issue of a call to action, what I need to do. If I need to buy at a certain point of time, sometimes behavioral biases or the situations of fears do not allow us to buy when markets are falling. Similarly, when markets are high, people tend to think on a risk off mode, and they tend to overbuy or probably overinvest, or do not appreciate the risk when markets are going up, which is basically sell when the markets are high. Plus, to be able to do this rebalancing and so on, it takes an effort. You need to know the timing is right. If you get out of A investment strategy, where do I get in as a B investment strategy? So both the calls have to be right at the same point of time. Then there is a tax angle when it comes to getting out of investments, entering something new, and then time frame starting again. So there is many variables which comes to in terms of an action to be taken. A balanced advantage fund first tries to take care of that by two actions, which is the behavioral issues which come in, which is greed and fear by low and high. And secondly, the other options of when to act, how to act, how much to act, and the tax angles. All of that gets covered here. So that actionable part first is taken care of. Second point, which I find as a benefit in this category, is that your extremes of the markets are managed in this product. So it's actually an extremity managing tool for an investor, that when extremes are high and low, you do not know what we should be doing. That's when this fund, because of downside, upside, as I talked about, is able to give you a middle path. So therefore, a downside and a upside protection and upside participation and a protection is what investors would probably look for. And that is why there are many investors who are now entering into this category. So these are the three reasons I would say so.
So Mayukh, one point that I would like to highlight, that in the global market, I mean, these models, these funds do not work. So do you think that these funds are good for Indian investors?
So Nishant, when you talk about global funds, global funds are very wide. So there would be some markets where this sort of a strategy may be working. At some places it may not. I would say that such funds experience are actually an underlying of what sort of universe are they investing in. That would be the first thing. In India, they seem to be catching up because there is a reason for investors to come in, because in certain of these schemes, investors know that they are coming in they know what sort of an experience stroke outcome they would get if they stay invested for a stipulated period of time. For example, in equities, people know that there would be some sort of volatility in the shorter end, but over a period of time, if you stay invested, power of compounding starts working better, possibly better for investors in equities. So you need to give that time and so on. Similarly, debt helps you to stabilize your portfolio and so on. So investors are aware of that situation. Where investors may not have got a good experience is probably if the calls have been either not been the opportune at that point of time, or possibly markets have been only been one-sided. So if equities have been falling and therefore any sort of equity allocation would be higher. But it's in volatile times, I would say, in a country like India, where overall, if your economy is growing and we are in a better position as has been talked about us as a growing economy, I think there is a merit in having a product which is able to do the allocation itself. The other products and other investments can help in the other objectives.
Great. So Mayukh, in mutual fund industry, we have product for every time frame. For instance, flexi cap are good for long terms, while fixed income funds are good for short to medium term goals. Where does BAF fit?
So I would say they would, from a time frame point of view, if you look at these funds, usually these funds are in the range of about say 40, 50 or percent or above on equity side, on an average, I'm saying. This is not too. So in that sense, that sort of an allocation, I would say that typically our view would be that investors should look at it as the medium and a long-term position. In the short term, the probabilities are actually of market volatility impacting the portfolio slightly higher. But over a period of time, I would say medium to long term it makes sense. For the most important reason is that it takes away the extremities of your portfolio experience. So in that sense, there is a space for this product to be there in medium and long term and can be a part of anybody's core holding.
So Mayukh, one last question. So many investors have invested in aggressive hybrid funds and conservative hybrid funds and may find no merit in adding another fund to their investment portfolio. So why do you feel that there is space for BAF in investors' portfolio?
Okay. So I think it's a right question, and that's absolutely the right way to look at it. My response to that would be, most of the other hybrid category funds are defined by the degree of each asset class in these products. So a conservative hybrid will have somewhere around 15 to 25% equity. An aggressive hybrid will be the reverse of it. It will be about 65 to 70 or probably 75% equity, depending upon how people are running it, and 25% debt. There, the allocations are static for life. The fund will continue to remain 25% equity on conservative, or say 75% or 70% on equity for life. They are not doing the dynamic management, but the investor is getting into the fund knowing that this is how the fund will be staying invested for the life of the fund. And does it so as long as I am invested in that fund, I will be getting 75% equity or 70% equity, whichever. I'm just taking a number to make that example. Similarly, on the conservative, I know for life, even if I stay invested for 10 years, it will continue to have 15, 20 or 25% equity. So there you are in control of the allocations, and you know what could be the possible outcome be at these rates of the asset of the allocation of the fund. In a dynamic, you are taking that call to the fund manager, who is taking this call on whether you should be 25 or whether you should be 75 on equity, and vice versa, therefore in debt, arbitrage, or any other asset, because there the call is with the fund management. They are taking some rules which is translated into a model on the basis of which they are deciding the allocation on behalf of the investor. So there it is a matter of static allocation. Your experience will be different. In a conservative, your experience is different because of the ratio of the assets in the product. Here, because on markets, as I explained, those three reasons why investors are coming into this category is that they would like to possibly give the fund manager or the scheme manager the view that they would be able to manage it as per the current prevalent market conditions. So there is definitely that middle path which fits into the hybrid category, and therefore investors investing.
Great. All right. So we have come to an end to this interesting session. Thank you so much, Mayukh, for giving us insights on balanced advantage funds. I'm sure it will greatly benefit our audience.
Thank you so much, Nishant, for having us. Thank you, and have a nice day.
Great, great. And finally, I thank each one of you for being such a wonderful audience. Have a great time ahead and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.